Einstein said everything should be made as simple as possible, but not simpler. Now, the tax return is very difficult, very complex. So I try to make it simpler. So first, let's play a game. Let's read this. In the beginning, it's difficult. You may fail several times. Once learned, you will never forget. In the beginning, it's easier on flat road. Once skilled, it's more interesting and challenging on slopes. Okay, what are you getting? Random sentences, right? Complicated non-random sentences. Now let's read. Bike. In the beginning, it's difficult. You may fail several times. Once learned, you will never forget. In the beginning, it's easier on flat road. Once skilled, it's more interesting and challenging on slopes. Haha, now what I get it. It's easier to understand, right? You're talking about bike. So what I'm saying is the context is important. And in tax, we feel overwhelmed. That's because we don't have a context. We just focus on the content. So I created 5 contexts for the content. The first context is intention. So Warren Buffett says, I pay less tax than my secretary does. Why? Because the intention of a tax law is to incentivize citizens to take care of their family, their business, and their society, community, by taking advantage of all the tax incentives. And then types of income. So there are 3 types of income, and when we plan tax, we need to be aware of that. And then the structure, which is the tax form. And then strategies. There are only 3 strategies you need to save tax: deductions, shifting, and exemptions. We will later show you some examples to help you understand. And then vehicles. In America, if you want to create wealth, you focus on 3 vehicles: real estate, business, and tax saving. And they all complement each other. And then you will be very easy to understand the tax system. So 3 types of income. First is earned income. That's like your salary or your K1, your S Corp. So earned income it's double taxed. First, you need to pay self-employment tax or payroll tax. And then you need to pay income tax. So in terms of tax, this is probably the worst type of income. However, you need to start with earned income, right? In order to qualify for a loan and then buy assets. And now you can have capital gain and passive income. And the passive income and the capital gain, you don't pay self-employment tax or payroll tax. So it's a better way of tax, okay? So you think about that, our tax system, right? You want to encourage people to work, and you want to support the people who are just starting, right? So you should tax them less, but in reality, we tax them more for the middle class families, okay? But that's the system we want to learn and we understand, and the key here is to use your earned income to qualify for loan and get into assets so that you can earn capital gains and passive income. And then passive income here, passive loss can only offset passive income. So that's where, when we plan, the creativity comes, and the context is important here. And then this is the tax structure we're talking about. Basically, you start with income, and then you have adjustment to income, and then you have itemized deductions, and then you compute the tax, and then you look at the credit. And then whatever you have paid, you get the deduction. If you overpaid, you get the refund. If it's underpaid, you need to pay the balance. So one way to simplify the tax is to look at them as just red light and green light, okay? when I was in school, I get confused about the tax code because I was just trying to remember everything. And then also now I look at it, in the entire textbooks, seem like it's all telling us about the red light. But if you really look at the tax code, it's just red light and green light. Okay, red light, stop here, pay tax. Green light, turn right, you don't have to pay tax. And then where do you pay tax? When do you pay tax? The biggest tax is actually capital gain tax. That's from a long-term, wealth growth perspective. And there are three stages you pay tax: the seed, the growth, the harvest. So for example, for traditional IRA, the seed is exempt. You get the tax deduction. The growth, you don't have to pay tax. When you receive the money, you need to pay tax, okay? Now, Roth IRA and permanent life insurance, it's after tax. You need to pay tax on the seed, but the growth and the harvest, you don't pay. So the way we want to plan is in the short term, we will take advantage of the deductions as much as possible and eliminate the tax that you have to pay right now. And then in the future, we try to convert them into non-taxable income, and then get the exemption. Okay, so that's how we use the three strategies, putting on the time horizon. So, for example, in this case, this husband and wife are making $1.29 million tax income, subject to $500,000 tax. So the way we do it is we put into 401k and cash balance, aggregated benefit plan, profit sharing plan, and we can save $500,000 tax, only pay $50,000 tax. And then in the future, we'll find ways to convert into Roth IRA or life insurance. Okay, so we'll create these low income years, and later on I'll show you an example. So you can use charitable strategies such as a public charity, donor advised fund, private foundation, charitable LLC, and you can deduct up to 60% of your AGI. AGI stands for adjusted gross income. So for example, you create a trust where you deed your house or your business into a charitable trust, and then when you sell it, you don't need to pay capital gain tax. In addition to that benefit, you also get a donation deductions, and then over the years you receive the interest or dividends from the trust, and then when you die, the trust, the fund will pass on to charity. It could be your donor advised fund or could be your family foundation. So for example, in this case, this family has a property that was bought at $2 million, and now it's sold at $10 million. You have $8 million capital gain. Now we put it into the trust. There's no capital gain. In addition, you get a $6 million deduction that you can use for the next 5 years to convert your 401k and the benefit plan, etc., into your Roth IRA or life insurance. So with the way you can give the principal to several charity, or the income stream you can also give to yourself and your children, as well as you can even use the income to buy life insurance, and over time the life insurance will create a cash value for you. And another way of income shifting is say your S corp is making $1 million, and now this $1 million is taxed at the highest 37%. So we can create a C corp and say the C corp is providing a service, be it MIS service or marketing service, management service, and then your S corp will pay a fee, let's say $300,000 to C corp. Now you shift income to C corp. The C corp has a lower tax rate, and also in the C corp, you can again create employee benefit plans like corporate sponsored life insurance, etc. Okay. So, and then this is another example of exemption. So there's the IRS give this section 1202 called qualified small business stock. So if you have a C corp and you after your fundraising, less than $50 million assets, you hold it for 5 years. When you sell it, you get a $10 million capital gain tax free capital gain. Okay, and then instead of paying tax now, the strategy is to build your assets, build your shareholder value, and then when you sell it, again you can use the strategies such as the charitable strategy that I showed you to avoid the capital gain tax, and then create a huge donation deduction that allow you to convert your 401k and defined benefit plan. And then you can, get this $10 million exempt. And another example of getting exemption is using 1031 exchange for your properties. So instead of selling it and pay the capital gain tax, you basically snowballing it. You take the equity out and then you buy a new property, and then you keep snowballing it. When you die, you pay. You don't have to pay any tax, and it has a step-up basis, which means your children, even if they sell it at your, on the day you die, they don't have to pay any capital gain tax. Okay, and then of course the qualified opportunity zone fund give you the similar benefit. It's like a supersized Roth IRA, basically a Roth IRA without limit, right? You put it in there, and after 10 years, you sell it, there's no capital gain tax. Okay. So, and you can see the difference it makes. So coming back, there are only 3 strategies you need to master. Deductions, shifting, and exemptions. That's how you create wealth. And that's how you master the tax system to work for you, to be your friend and over time, and help you to create wealth, generational wealth over time. And I tell all my clients, if you learn to use a simple strategy like this, in 1 generation, you will become a capitalist. You have capital and you become wealth owner. You actually have wealth, and your children don't have to work for money anymore. Okay, and I can give you testimonies for all the clients that I worked with, and including myself. I came to this country from China, and my parents were farmers. We have nothing, and now I'm able to send my children to private school. That's because I learned this system and used it. So thank you.